I started doing this in 2004. At that time, I didn't know how to analyze gold and silver mining stocks. Took me, I would say, at least 6 years to learn how to do it. 2 minimum, and there was no books, so I wrote my own after I learned. So I wrote this book in 2010. It's the only book that explains how to analyze gold and silver mining stocks. It's very detailed. It's basically a textbook. Highly recommend it. You really enjoy it. This is my website, Gold Stock Data. There's 830 stocks in there. At one time, there were 900, so we've lost 70. Plus, it's quite a few, so over the last few years, they've been kind of whittling away. It's not really a stock picking website. It's more for people that already own them and they want to expand their portfolio. It's a very good resource. You can follow me on Twitter. My handle is Don Durrett. I spend a lot of time on there. So now we're going to start exploration stocks. I'm going to do exploration, development, and producers. This is very useful for people that are kind of new, want to get some tips on how to analyze these things. I've learned that if you're not excited about an exploration stock, then don't invest in it. You need a high conviction, otherwise there's too much risk. Type A companies, they already have a large deposit and they are undervalued. The optionality plays, this is my favorite place to do it. Free Gold Ventures, who is here today, they fit into that type A. Type B is a company that's drilling a discovery, and you always want to get in early and not to chase these stocks. And then type C is one that doesn't have a discovery and they're trying to find one. I call these lottery picks. So those are kind of my 3 buckets for exploration. And the best drill stories are those that have a high likelihood of expanding a known discovery and are undervalued. And you always want to avoid exploration stocks that do not have an excellent discovery hole. And this is where the risk really goes up for exploration plays, because people will go after ones that don't have discoveries. Now, you might get lucky once in a while, but the risk reward is daunting, if you will, that I've learned. So what is it? What is an excellent discovery hole? So you want a gram meter of at least 200 for a gold miner. I prefer 300, but if they don't have one of these discovery holes, somebody did a study a few years ago, and they found that every mine that's in production has had an excellent discovery hole that's over 2 million. I forget the exact number. It was like 90%. And so the bigger the discovery hole, the bigger the mine. The correlation was really, really strong. And I took that to heart, and I believed it ever since. And so you want to look for these discovery holes. All right. Location is important. The reason why is because it can impact the cost of drilling, the cost of development, and the ease of permitting, and that comes into play. So you always want to take location into consideration and kind of know what the factors are. The reason why it takes about 2 years to understand how to do this stuff is just all the little details around the location. Why do these things why do they merit consideration? So you have to, but take that into consideration and always put in, where is it located, and then why is that important? Okay, insiders are important. The reason why I prefer to have 25% or more. Now, the way I define an insider is an investor who has no plans to sell early. The insiders are not there for a 30%, 50% return. They're there for the long haul. And so I like if they don't have that, if they don't have it, they're more likely to sell the company early. And so the stronger your insiders are, the more likely that exploration company is going to be around a while. I try to keep my allocation low for explorers, only around 5%. I'm currently at 8%, and I feel like I'm overweight. And the reason why is because the risk reward, like I said, it's fairly daunting for exploration stocks. But I like to dabble in them. Some of them absolutely make sense. You just have to be smart about it. But anybody that's doing 15, 20% of their portfolio in exploration, they're taking oversized risk, if you will. And the reason why is these are generally one and done stocks. And what I mean by that is they find they find a mine, they find a discovery, and then they drill it out, and then they sell it, and it's done. And then they go on to the next one, but it's hard to find big mines. And so usually you're done with that exploration stock, one and done. And then the other thing is usually the upside comes early. So I have a stock, they make the discovery, and then the first year or two, the thing is a 10-bagger, and then it's kind of at the top, and then it lags. So some of these exploration plays, you have to get in early, and then you have to get out once they make that first 5, 10-bagger move. Okay, now we're going to do development stories. So I have 2 development stories on my panel here today, which I get to talk about both of them, and they check all the boxes. One of the things I've learned, and I've been doing this for about 20 years, is that development stocks, you have to be very smart on your selection. And the one thing that you want to do, I think, you want to only find the ones that check all the boxes. So what are those 6 boxes? The first one, it has to be a strong project. So it has to have good location, long mine life, good economics. And then the next thing it needs to do is be undervalued. It has to have high upside potential. And the reason why you want it to have high upside potential, because development stocks do not have revenue. So they're going to have to raise a lot of money to get there. So if you don't start from a high place, it's going to whittle down. So that's why I want to start at least at a 10-bagger. And the higher the better. And then because you're taking so much risk, the risk reward, you want to make sure it has that. And then good location. Ideally, you want a mining district. That way you're more confident it's going to be permitted. And if it doesn't have a mining district, then ideally you want it in a mining-friendly country. But you be careful with the location. It's always a big factor. Number 4 is the management team. What have they done? Are you confident that they're going to be able to build this mine? And so that's a big factor. Number 5 is the path to production. This might be the most important checkbox. And I've ran into companies, I can generally get a feel for a company's plan on their company website, on their presentation. If they know what they're going to do, they usually will tell you. They have confidence. And the stronger the plan, the better. But I've learned over the years that biggest mistakes that I've made in exploration is companies that don't have discovery holes. The biggest mistake I've made in development stocks are companies that don't have a plan. Now, some companies, they don't have a plan because they're not ready yet. They have to get to a certain point. Like I gave Aftermath Silver, I interviewed Mike, the chairman, a couple times. I kept giving him a bad time because I didn't like his plan. And I own your stock, and tell me what you're going to do. And he kept telling me, well, we need to understand this manganese before we can do a PEA, because, tell me, because I want to know, what's the silver revenue, exactly how. And I wasn't comfortable with it, but I still went with it. But I like Aftermath. I still own it. But the better the plan, the stronger the plan, the better. I like a company that tells me what they're going to do, and then all they have to do is carry it out. And as long as they have the team to do it. The next one is the insiders. And this one here is another one where it's almost as important as the plan. And I've been bitten many times buying development stocks, because development stocks is usually going to take you a 5-year investment. It's usually always going to be at least 3 to 5 years. It takes a long time to build mines. And so what happens is I'll get in early and they'll sell the company before they get to first pour. And most times when they do that, they don't have strong insiders. Both of these companies up here on stage, they have no plans of selling early. They both have strong insiders. That's one of the beautiful things about them. The MPV and the CapEx. This is another one that people don't really, people that are new to this, they make this mistake. And they think that the project has strong economics, but it can have strong economics, but it might be difficult to finance. And so the bankers, they want to see a high return, which is your MPV, and they don't want to pay very much for the loan. So you want the CapEx to be about 2x the MPV, and it's nice. Vizsla came out with a 5x. Their MPV was 5 times higher than the CapEx. That is going to be a super easy mine to finance. So if you get one that's 2x or 3x, they're easier to finance. That's just the way that it works in banking. Allocation. I like to allocate about 20 to 25% in development stocks. The reason why is because they can have huge returns, and well, the other reason they have huge returns, but they turn into producers. And I want to own as many producers as I can. I feel like I'm going to make 80% of my returns on producers. So I own a lot of development plays because the combination of the high returns, the big alpha, I'm chasing big alpha. I want to have at least a 5x return or higher. I've always chased high returns because I believe in this business. If you're going to take a high risk, you better get a high return. And so development plays is one of the plays where the risk reward can really work. Now, it can be a long-term investment, but it can really work if you have all those check boxes. And now here's the risk. The one thing about development plays is everybody will learn who does this, is they can disappoint you in many ways. I say one of the sayings that I says is they tend to break my heart. Development plays tend to break my heart because there's so many ways that they can kind of go south on you. The first one where they go south is they sell the company. And then when they sell the company, you want a 5x return, and then they're only going to give you a 50% return. I don't want 50% return. A lot of times you're like break even when they sell because the re-rating and the higher value, that comes after they get into production. So if they sell before they're getting into production, they haven't gotten re-rated higher yet. And so the buyer's getting all the upside. So that's kind of the biggest risk. But then once they start to build it, well, before they build it, they go to do the financing. And when they do the financing, they have trouble financing the project. And a bad financing always hurts your shareholder. And I've been through a lot of bad financings. I don't want to give too many examples, but there's one company, they financed the company all on gold streams because they couldn't get a loan. Those gold streams are usually one way, they're tough. And so you don't want to see stuff like that. Ideally, you want a 70-30 deal, 70% debt, 30% equity. Those are like the best types, but you don't always get those. So how they finance the mine is always a crapshoot. You don't know how they're going to do it, and it can bite you a little bit. How they actually do it. And then the dilution, if they can't get a loan, they might have to do 50, 60, 70% dilution. And you never know how that's going to do. And then they can have ramp-up problems. Look what happened to Ascot. They tried to ramp it up, and they had to shut it down. They had to raise a lot of money. Ascot, that's a good example of a ramp-up problem going south. And then they can have cost problems. Cost problems are just going to lead to bankruptcy. And those always. So development stocks are never sure things. You're going for high alpha, and that high alpha doesn't come without a risk. It's usually a 3 to 5 year investment, and it's not always a slam dunk. I always tell people to keep your allocations low. Know what your pain point is. Know what you can afford to lose. For me, if I usually do 0.5% of my total cost basis on a development play. And I take the emotion out of it. I don't really, care if a company fails. I own both of these stocks. I don't expect them to, but I take the emotion out of it. I have 163 stocks. I own a lot of them. And I probably own 28%, I think, of my cost basis. So I own probably 40 development plays, quite a few. What I do is I let the winners appear. I don't try to pick winners, although I think both of these have high probability. I try to find the ones that have the highest probability of being winners. But if they fail, it doesn't really bother me that much. I just replace it. I just go buy another stock. That's the way that I do it. But my point is that don't marry these development plays and think they're going to work. Okay, so here's the type. So type A is a near-term producer under construction, and these have the lower risk. And then B is a near-term producer, construction within 2 years. And then type C is under construction within 2 to 4 years. And as you go down this list, you want to allocate less. There's more risk involved, and you don't want to have as much total allocation. And the last one is a long-term construction. So I don't own too many that are more than 4 years. I want to have, I want to have a lot of the A's and B's if I possibly can in my portfolio. Producers. So you want to avoid pricey stocks. Now I say less than a 3-bagger. Unless you are after dividends. Now, the reason why I say this is we're after alpha, but if you're affluent, if you're rich, I always say that then you want to own these ones that are, I always say you want to have Newmont, Barrick, Agnico, and Alamos, and Lundin. Those 5. If you're rich, you want to own $100,000 of each of them and collect the dividends. But if you're not rich and you're trying to get rich, then you want to avoid these pricey ones. High risk, avoid high risk locations. Now, we mentioned that every single time, right? Avoid high ASIC stocks. So you want companies that are going to have free cash flow. And the reason why is because they're going to get higher free cash flow multiples. We want stocks that investors are going to like to own. So the high cost stocks are not going to perform as well. So you want to avoid small producers unless they have production growth potential. This is something I've learned. I don't get excited about small producers. The small producers, they're usually going to be very, very low market caps, but they also are not going to have high free cash flow. They're going to have trouble growing. I want a company that's going to grow to at least 500 million and ideally 10 billion. So that's kind of my range. I want a company that's going to grow somewhere 500 million to 10 billion. And a lot of companies, I like to buy them around 100 million, 150 million, and then they grow to a 1 billion plus. I'm always thinking in terms of the alpha, what it's going to be. I never think in terms of the next 12 months. So for small producers, I'm very selective. I think I have Talisker Mining, but I think Talisker can turn into a mid-tier. The others, I don't own very many 163, very few small producers. Another small producer, I like Impact Silver, just because there's very few silver producers. But on the whole, I tend to avoid them because just the risk reward doesn't work. For producers, you want to look for companies that have a pipeline. So a pipeline is basically they have more projects, they have a way to grow the company. I want a company that would have what I call a positive feedback loop. And this is something that both of these companies are going to end up doing. And what a positive feedback loop is, you get into production and then you start looking for additional resources on your property. So it leads to exploration, leads to growth, and you get this positive feedback loop and you grow that way. And that's what kind of the pipeline's all about. How much exploration potential you have, how many additional projects you have. And then I also want, for producers, I like aggressive management teams. I want companies that are going to grow. And I call them sharks. I want to own the sharks. And it's the sharks. I always say you don't make your money on the first mine, you make it on the second mine. For instance, Hugh, Revival, he's going to build his initial open pit, Merkur, but I'm going to make my money when he builds Bear Track, the second project. And for Kimberly, it's the same thing. It's probably going to be her second mine that I make my money on. You want to look for companies with solid free cash flow and an excellent long life mine they can leverage. If a company doesn't have what I call a flagship property, then they're not going to have, it's tending to disappoint you. They need something that they can lean on. And McEwen Mining, for instance, for the last 5 years, they haven't had a flagship property, and I felt sorry for them. They just can't get on their feet. And you need that one flagship property you can lean on. You want good balance sheets on producers. This is kind of a pet peeve of mine in the industry. The industry tries to run their finances, their balance sheet, like they're a normal company, but they're a cash business. And if you're a cash business, you should be cash focused. So I want to own companies that have at least 100 million in cash and no debt. That's what I want. I want clean ones. Now I allocate about 50% to producers because I think that they're going to do the best risk reward. I think I'm gonna get 80% of my returns through producers. And the reason why I like producers, and I ended here, is that they have 4 ways to grow the company. And developers and explorers don't have these. They can go through higher gold, silver prices are gonna increase their cash flow. They can do an acquisition, they can do exploration, they can do development. So that's, I got these, I'm out of time, but these are the 5 buckets. The majors, I define a major as greater than $4 billion market cap. There's 25 of them in my database. Mid-tiers, 80,000 production, 60 in my database, and then small producers are 60. So there's only 145 producers. That's not that many. Total market cap of gold miners is 550 billion, silver miners 55. This is in my database, so it's probably, the entire market is 700 billion. I think it's gonna go 10x. I think it's gonna go to 7 trillion in the next 3 years, which is kind of crazy, but that's my expectation.